Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Charles Biderman, manager of the Comgest Growth Emerging Markets Fund. Hi Charles.
Hi Emma.
So we're talking about emerging markets today, and we should start with the largest holding in the fund, and indeed probably the most important if we're looking at the news headlines at the moment, and that's China. Sizable weighting. How do you feel about it?
Yes, well, China has been, let's say, volatile in the past year and a half. And, at Comgest, we are more stock pickers. So we don't really look at the macro, we don't look at the short-term volatility. We're much more interested in what's going on over the long term. So what we have been doing in China is just sticking to our approach, meaning that we're looking for quality companies that will grow over time on a sustainable basis. So we have used the volatility of the market as an opportunity to adjust and fine-tune our positions.
The good thing about stock picking, as you say, is you can ignore the rest of the market, you can ignore the macro, but when all of the market is dragged down and all the market is dragged up, it becomes difficult to just be able to trust a stock on its fundamentals. I suppose there are concerns with China that the way that you evaluate a stock becomes null and void because the government's hand is so strong in the playing of the market. I mean, is that a concern for you, or do you trust the process enough that whatever the government does, it will out?
Well, we've been investing in emerging markets for more than 20 years. So, we have this kind of experience, and we know that short term, yes, there will be noise, and there might even be impact on a operational basis. But over the long term, and when I mean long term, it's like on a 5-year or more basis, then fundamentals will prevail, and we do have trust, and we do really stick to our convictions and to a process in that case. So, for example, we're investing right now in China Life. This is a life insurance company in China. It has 30% market share. It's just to give you an idea, it's just incredible the size and the magnitude of things. China, the middle class of China is still small, but we're talking already about 300 million people. So 30% of that, it's just huge, right? So they have 700,000 brokers selling the premiums China Life throughout the country. And it has been growing at double digits in the past 15 years. And given the level of penetration today, it's most likely that will continue in the next 15. So, all right, this year might be a little bit more problematic or volatile, but we're pretty sure about the next 15 years, and so we stick to that.
Let's jump across the globe then to another one of your sort of overweight holdings, and that's Brazil. Yeah. Latin America in general has had quite a difficult period, both looking at on sort of a stock-by-stock basis. There have been a couple of scandals with individual companies. There's also been the macro overlay of almost every single country in Latin America has had an election in the last 5 years and coming up in the next couple of years. But there are signs that show that Brazil is perhaps turning a corner. Where do you see the opportunities within that, and are you sort of positive that Brazil is turning the corner?
Well, politics is always a big theme in Latin America, no doubt about that. Brazil has gone through elections. Dilma has been re-elected, and it looks like it's going to a different direction than what it used to. It's just like they have no choice. They have no money left. They're running current account deficits, and they have to address that, and they are. Are we at a turning point or not? The next few months will tell us really if it was just announcement to reassure the market or if it really be facts behind it. At least the first signs are encouraging in terms of what's the direction that they're taking. But, then there's still talk is cheap. So there's still a lot to do there. But despite this slowing macro and this difficult environment, we're still able to find companies growing more than 20% EPS. We have WEG, the electrical motor manufacturer in Brazil. They're growing more than 20% in the first half. GDP will probably contract by 2% this year. Investments are falling, and they're still growing more than 20% because they have a lot of recurring revenues, because they are investing abroad as well, and just because they have an extraordinary product.
I suppose it's like any market, 70% of the revenues of the FTSE 100 come from outside the UK. So just because a stock is listed in Brazil doesn't necessarily mean it's dependent on the Brazilian stock market, Brazilian domestic market rather.
Yes. There's still so much to do within Brazil that, I mean, companies, they're still more, I mean, they're less international still than what we can find in the UK, for example. But you can find those companies that have operations abroad. That's certain, yes.
Charles, thank you very much.
No, thank you.
This is Emma Wall from Morningstar. Thank you for watching.